Hello, Uncle Jim here. Today I want to share with you several companies I'm looking at that are good companies for a bear market, at least for selling options during a bear market. These are companies that I've got positions in most of them, but they're inexpensive, but they pay good dividends and they're value companies, so they're a little bit less risky than a lot of the other investments that are out there. I also want to share with you in this video kind of my take on what's happening and where the market's going from here. So stay tuned. I believe you're going to really enjoy what I have for you today. I've been an investor from probably the early 80s. I went through several crashes like 1987, also dealt with, 2008 and 2001 and a lot of different kind of bear markets as well as crashes. So, what do I see coming? I don't It's really hard to tell, and a lot of times, you can end up being wrong. But I do think we're going to probably end the year maybe a bit lower than where we are today. I think the market is right now we're still having good earnings, but I've noticed that they're not as good as they were last quarter, and I do believe that by the end of the year, because of supply and inflation, that the markets are going to be potentially a bit lower than they are today. But I honestly don't know, and a lot of times when you think you're proven wrong again and again and again. So for me to be able to deal with this kind of a market, and I do want to reiterate, one of the worst things you could do is sell when the market's dropped considerably. If you wait it out, it typically always comes back. There are people I know who got out of the market after 2008 and never got back in, and they lost lots of money and lots of upside. So the worst thing you can do is sell or take big losses at this point. Now, when you're selling options, you don't always have that choice. So, for me, I like to stick with value companies that pay good dividends. I will invest in companies like Apple, and I have made some, bad decisions in the past, like with ARK, Innovative, ARKK. I did take a big loss with it, but I'm currently not writing any positions on those. I'm trying to stick to less risky companies that are probably near their 52-week low or close to it and that are paying good dividends. And the dividends is a big deal for me because I don't just live off of the premiums from the options, I also live off of the dividends. And, if you can get some good companies, especially after the market's gone down quite a bit, if you can pick up some good companies that pay good dividends, you can, you can be a lot healthier down the road. If you get something near its 52-week low and you get a much higher dividend, especially for companies that grow their dividends, then every year it's going to increase, and your dividends are going to be even better down the road 4 or 5 years if they're increasing them every year. Now, I am changing my strategy a little bit. I've typically been a 20 delta. I'm trying to keep it closer to 15 delta now. I'm still going to have some that are 20 delta, but I am taking a little bit less risk. And that just means I'm going to, if I'm looking a $50 stock and I'm looking to sell a put at 45, well, I may go a little lower to 43, 42, something along those lines. If the market goes even farther down, then I'll look at a 10 delta. I've still been able to reach my goals each month. Even for April, I'm over $3,000 in my premium, but I do feel like I'm going to have some issues in May. I do have a couple of positions that are fairly in the money, and I may have issues rolling them. One in particular is Intel, and I may end up letting it be assigned and own those shares because they are at a value that I'm okay with owning them. Another thing is I like to disperse the expiration. So if you're selling options, try not to have a lot expiring at the same time because it might mean it's much harder to actually roll those at any particular time. So I try to disperse my expirations so that they're not all expiring on the same day. So and sometimes that's hard to do because there's certain expiration days you find that just have a lot more premium. But if you can do it, try to do it. And then also planning. It's really important to plan. You don't wait to expiration. Keep track of the ex dividend dates and earnings, and have a firm grip on what your positions are doing. Are they in the money? Are they out of the money? Every Monday, I put a new planning worksheet out and I identify any of my positions in the next 3 weeks that are either in the money or that I have to be really diligent about managing them to be sure that I don't take a big loss. Or maybe if the market really goes a different way, I may be able to roll it at one point, whereas the day before or the next day, I might not be able to. And then, it's also it's just a good idea to have a planning worksheet. And I write down my ex-dividend dates. I'll keep track of earnings. The reason for the ex-dividend date is a lot of times assignment will occur right around the ex-dividend date. And it kind of makes sense. People may want to own the shares so they can pick up the dividend, or they may want to let go of the shares after they've already, passed the ex-dividend date and they're guaranteed to get the dividend. So those are kind of important things to keep in mind, and especially so with a down market. If the market continues to trend down, I'm also going to probably look at lowering my expectations. Instead of trying to get between 2,500 and 3,000, I may go back to 2,000, $2,000 a month, or 2,000 to 2,500. Trying to take less risk and trying not to be greedy. Or what I found in the past, if you get too greedy, then you can end up in trouble. So, well, that being said, as always, please hit that like button, subscribe. Take a look at my Patreon. I share my trades. We have a weekly meeting for the higher level membership. I'm also going to be sharing some of the watch lists that I work with and any of the spreadsheets that I share. I also share to all my patrons. So take a look. It may be worth your time. And with that being said, let me jump into my actual account. I'm going to show you my watch list and those stocks that I'm looking at currently to either roll positions or open up new ones. So thanks for joining me, and let's jump into that next section. Okay, I've opened up my Schwab account and I brought up my watch list. This is a new watch list that I created called low price watch list. It's for this particular video. And these are all companies that are below $50. Actually, most of them are below $20. But the most expensive is Cisco, and the least expensive is, I believe, Lumen. Yeah, Lumen is the least expensive. All of these pay pretty good dividends, and they all are pretty close to their 52-week low. They're definitely on the lower end of the range. So I'm just going to kind of go through the list. So Lumen pays, and let's actually go to the basic view so you can really see some of the information. So Lumen is a good company. They've gone through some restructuring. Their earnings have disappointed a little bit recently, but they are paying 25-cent dividend, and that's per quarter. So it's $1 dividend, which is close to 10%. When you look at their price. So the dividend is really good. The dividend yield is literally almost 9.62%. Analyst ratings, they're not the highest. Let's actually sort this by name so we can find. Well, here's Lumen. It's C. Morningstar gives it a pretty good ranking. Almost all of these, the worst case scenario is C for Lumen, and I believe Ford is also a C rating from Schwab, but they all have fairly good ratings, so that's nice. And then price performance, that they're all down. They're all a little bit inexpensive right now, which is good. So makes it a little bit easier to afford selling options, especially if you have a small account. If you're Luminous, all of these are good stocks to trade in a small account. I guess Cisco and Fidelity National are a little bit more difficult to sell in a really small account, but for the most part, everything else, Western Union, Big Five Sporting Goods, all these others are less than 15. Western Union, I believe, is below 20. So not that expensive to deal with. But let's jump back into Lumen. Let's actually look at Lumen. So we'll look at they are again near their 52-week low. They've literally got a 5 to 7 PE. Their current price to earnings is 5.45. And again, their yield is surprising. And if you look at their earnings, it's not bad. their earnings were going up. This year it's going to be down a bit, but some of you may be asking, well, is their dividend protected? I think it is, and I think they're going to have better. Their numbers are going to go up with a lot of the restructuring they've done, and their ability to actually be able to. Excuse me for that. I've unfortunately got a pretty bad cold. Had to deal with the flu 2 weeks ago, and now I've gotten a cold. Um, so hopefully I won't be clearing my throat that much. I know it's a little bit aggravating. Um, so their earnings are down, their revenue's down a bit, and a lot of that has to do with restructuring. You can see their cash flow is pretty good, um, but they are buying back shares. They are taking a lot of lowering their amount of debt. They're taking a lot of steps, and they really have some really good growth potential coming up in the next couple of years. So let's go back to the summary again. Actually, let's look at options, and they're very optionable. So all these are very optionable. You can see here, this is for the expiration on May 20th, and you can see the open interest. They've got a lot of open interest at $9, $9.50. Um, so it's fairly easy to sell options on them. So it's the least expensive of all the companies, and again, you could sell a cash secured put for $9 and be making, or $9.50, and make pretty close to 25 or 30 cents. For every $9 to $9.50 that you're um, putting at risk or needing to use margin wise. So Lumen is the first company that I wanted to talk about, and it's definitely has some good potential. Let's hit back here a few times. We'll go back to the main page. Next is Haynes Brands, and in my mind, it's got a B rating. It's also traded in a very small range. It's got a low PE, 9.21. It's paying a good dividend, 4.42. Um, let's look up here at earnings, and it's a fairly safe company. So the earnings are down slightly. It looks like for 2022. Let's actually look at it quarterly. But up until this last quarter, they've been up quite a bit for every month. So it's another good company with 4.53. I think that's what it was for the dividend year yield. Let's look, 4.42. But if you can get it around, let's see, it's trading at 13. If you can get it at 12, you probably would have over a 5% dividend yield, which is really nice. And let's look at the dividends, and I believe, I can't remember if they're steadily increasing them or if they're keeping them the same. They've been keeping them the same for quite a while, back from 2017, and before that they were increasing them. So, and they've got a lot of cash to cover their dividends, so it's not at risk. The dividend is not at risk. And let's look at options. Not as much option interest, but still quite a bit. 989 open interest for 13. 1250 38, that's a little low. 12 132, and again, this is for expiration May 20th. So for a 1250 strike price, you can get between $30 and $45. If you wanted to take a little bit more risk because you really wanted to own it, then you could get $50 to $60 per contract, and again, that would put you at a really good dividend. So Haynes Brands, I use them for my underwear and t-shirts and things along those lines, and they're a pretty steady business. They're not going to be hit as hard as some of the others. I don't know about manufacturing. I do think they do a lot of their manufacturing overseas, so I don't know exactly about that, but let's look at ratios too, out of curiosity. And their ratios look good. Again, their PE is low. Return on equity is through the roof at 68. Let's look at their dividend coverage. Dividend coverage ratio 244. So they've got, the higher that is, so 244 means that they have a lot of coverage for their dividends. So it's almost like for every dollar they've got $2.4 to cover that dividend. So the dividend's not at risk. So again, another good company to trade on, and it's very optionable. So HBI, I currently don't have any positions on it, but I've been looking. I've been close to making some trades with it, and maybe in May I probably will. I doubt I'll do anything more in April because I've reached my goal of over 3,000 for this month. So let's go back. Sorry, keep hitting back, back, back. I probably could have found a better way to do this. So Ford unfortunately had some bad earning. Well, their earnings were good, but I believe they purchased a electric vehicle company, and I think that's pulling them down a bit. So I think in comparison to what they did for first quarter last year, they're down a bit. But Ford is another company I like. I like their decisions they're making. I like their F-150 Lightning. I've mentioned in a lot of other videos looking at buying one of their trucks. So if we look at earnings, I don't know. They reported last night, so I don't know if they've updated the earnings on Schwab. So it's still showing fourth quarter, so it was down quite a bit. I'm just a Ford fan. My son is a Mustang person, and so we've just always liked Ford. And actually, my some family members, they worked for Ford at one time. So we actually had the A plan, I think is what they call it, and we bought them out years ago off the A plan. So dividends, I think they've held steady. I don't think they've increased them, and I think they have plenty of cash to cover them. Actually, they reduced them in 20 and 21. So dividends are relatively low. They've reduced them. So yeah, it's not as good a play dividend wise, but um, even with what dividends they are paying, it's still getting a pretty good 2.69 dividend yield. Um, but Ford, what's amazing with it is how much interest there is in options trading with them. So you can see, I mean, look at the open interest. You're talking 17,000 at 13, 6,500 at 12, and you can make some pretty good money selling options with Ford. And I've been selling options on Ford for quite a while now, and have done fairly well. Now I do have some that are 16 that are fairly deep in the money, but my guess is they won't be too difficult to roll when I need to roll them. And I do think Ford's going to come back. You can see where they were not too long ago. I think they're going to come back. I think they'll come back maybe to the high, like 16, 17 range, but they did go way up recently. Long term, this is back 3, 4, 5 years ago. Um, so it is a little riskier than some of the other ones, but it's I don't know. I've been able to trade pretty easily with it, and I don't think it's going to go from 15 to 2 or 15 to 5. I think worst case scenario, it may go down to 13. I think it's going to probably stay above 14, and I think it's going to go back up above 15 probably within a couple of weeks once the latest earnings information is kind of a thing of the past where people aren't focused on it. I think a lot of people are focused on the fact that when you compare their earnings to the same quarter um, last year, yeah, you can see here it was 81 cents, and I think they released 38, so they were a cent higher than what they were predicting. So, but it's still considerably less than first quarter last year. So we'll see. There's a little bit of risk here compared to some of the other ones, but it's one of the companies I like to invest in. Let's go back. I'm going to go a different way this route. I brought it right back up. So next is Big Five Sporting Goods. This is one I've actually sold some options on lately. Another good company. They've got really good numbers. It's with people getting back into athletics after um, COVID. I think it's a really good value. It has come down. It's a B rating by Schwab. Let's look at earnings. I think earnings look really good. It was down slightly. I think this was third quarter. Fourth quarter was up slightly. Um, on an annual basis, yeah, it's going to be down a bit in 2022. So but it looks like revenues are up. So it's like what's happening to a lot of the retail companies. They're getting hit hard by transportation costs and supply chain. And the inflation, everything is more expensive, but I still think they're going to do really well, and their pricing, let's go back to summary, isn't outrageous. It's a good value, and I've been able to do pretty well with them. Um, so right now at 14 or just shy of 15, it's at a good level. It did get lower back in 2020, 2021, but I think looking forward, it's a good company. It's well managed, and let's look at options. I believe it's very optionable. Not as much, but at $10 you can see there's 67. So it's not as well. You can see over here for covered call. So this might be a great play for the wheel. So you could put a $10 call or a 12 not call put. You could sell a put at 12.50, pick it up, and then you might have a lot more opportunity to make some good money selling covered calls on it. So it might be a really good option for the wheel. So, and like I said, I've actually sold several of puts on this, and I've done quite well. I think I've not even had to roll them. I think they just expire, and I open up new positions, or I close them because of profits. I'm able to get my 85% or better in the profits. So, again, another good stock to trade, and I do think it's got really good future growth potential. Now, next is Western Union. This is another inexpensive stock in my mind, and it's paying a good dividend. I believe it's paying over 5%, and it's in a good range too. It's not overly priced. It has a really low PE. Let's look at its earnings. So not bad. It was up again. Everyone's going to be down this year. That's why I said at the beginning of this video, people need to trade safer securities. You need to take a little bit more risk until we get through this. But it may, say we do have a much worse year than what I'm predicting. I'm thinking we're going to be right level by the end of the year, meaning we didn't make any. The market's going to be about where it started the year or slightly down, like 2, 3, 4%. But if I'm wrong and it's 10%, then it will go back up at some point. And then when it does go up, then you can do really well selling covered calls, and hopefully at some point it won't be so volatile. But that's where I think selling companies or selling puts on companies like this turn out to be really, really good. And I did open a position very recently on Western Union, and it's again very optionable. A lot of open interest. Here at 18, you could do what between 40 and 50 cents. You could do at 17 between 20 and 25, and you can, depending on the bid and ask, you could also do a vertical put credit spread if you can pick up something in the $10 range at much less. So you could, you don't put a whole lot of money at risk when you're doing this, and in a way you can do cash secured puts pretty regularly. But again, you could probably do really well with buying an outer arm at like $4 or $5. So again, another good company, Western Union. Ratios. Let's take a quick look at the ratios. um, Return on equity is through the roof. Let's see the coverage for the dividends. Because if you're going to base it on dividends, you want to have enough dividend coverage, 209, almost 210 for coverage. So for every dollar in dividend, they've got $2, which should, let's look at dividends. I don't know if they've been increasing them. So, if you went back to 2012 and you had a 43 cent dividend, and now it's 94, that's pretty good with dividends. So if you buy this now, you use the wheel to buy it, sell, put, pick it up, and hold it for 4 or 5 years. You could, 5 years ago it was what, 76 cents. Now it's 94 cents in dividends, which I think this year it's going to be closer to 98 cents. So another good company. Like I said, it's very optionable. So another great play for small accounts or to minimize your risk and to look at dividends, not just premiums, options premiums, that is. So let's go back to the watch list. So again, another good company. And like I said, I just I sold a put, I believe, earlier this month on Western Union. Now, Fidelity National Financial is a little bit more expensive. It's, what is it, close to 39, 40, or close to 40. Well, you can see it's got an A rating. Its numbers look unbelievable. In a way, I feel like at some point this may get into the 60s or 70s. Um, it's paying a 4.44 dividend, and I've never seen a price earnings that low, unless it's a utility. 4.75. Let's actually look at earnings. And so earnings are, again, same old story. Everyone's earnings, they're projecting 22 is going to be lower than 21, but they did really well in 21. They were up almost 7% above 20, and I think 20 was up 15% over 19. And then their revenue is down a little bit, which kind of makes sense. And then cash flow is really good. Look at that. So they're putting away a lot of cash. And let's look at dividends. I believe they are a dividend aristocrat. So you can see they've increased it every year. The same situation here. If you bought it back in 2012, which is, what is that, 10 years ago, it was 58 cents for the dividend. Now, if you kept it, it's nearly $1.60 in dividends. So it's huge. If you buy it now and keep it for 5 years, you can be making a really good amount of dividends off of it, which in my mind is the most passive income you can have are the dividends. They just get deposited in your account and you don't really need to worry about anything. Now, options, I do know they have a lot of open interest. Well, not on that day, but they do over here for the covered calls. It looks like at 40 they did. So with the fact that it's down 29 cents, they typically have quite a bit, but I guess because it's dropped a bit today, but it does. Typically, what I found is it does have a good amount of open interest, and you can do really well with selling covered calls on it too. But it doesn't trade in a huge range. That's the other thing. So you don't, you might buy a 38 put or sell a 38 put because it really doesn't. I mean, this looks huge, but if you just put it to 1 year, you're talking between 40 and 55, but really recently between 40 and 50. And again, this is fairly low. I think it's going to come back. Let's look at the ratios. I believe the dividend coverage is pretty good too. Let's come down to that dividend coverage. Because a lot of these, when I invest in them, it's related to the dividends. I want to get that dividend, and I want to own it now so that the dividend is even higher in the future. So 540. So for every dollar in dividend that they pay, they got $5 of additional income. So they are just a cash producer. Their cash flow is through the roof, and as you saw with the dividends, they are just a good company to own. So another good idea is, again, to do the wheel or just to be selling puts, and you can take maybe a little bit more risk, but like I said at the beginning of the video, I'm taking a bit less risk for a slightly lower amount of premium because I don't want to get caught with my pants down with any of these. But Fidelity National, I've been selling options on them, especially puts, probably going back 6-7 months now. I probably have done 4 or 5 trades on it, and I, just like a lot of the others, I believe I've been able to either let these expire or close them with a good profit. So, and I think I've rolled them. I believe I do have some that I need to roll coming up soon. Um, so I think we're almost done. Let's jump back into the watch list. And then Cisco kind of talks for itself. It's up a bit today, but it's below the $50 point, which I have some puts that I sold. I believe they're vertical put credit spreads, but you can see where it is, and I'd sold them at the 50 range. So it's right near its 52-week low. It's paying a 3% dividend, which is unheard of on a technology company, and I believe that's why they got hit really hard is because they are a technology company, but their PE is relatively not too bad, 17.64. Their forward PE is 14.32. Um, I believe their ratios look really good. Let's look at dividends first because again, I believe they're a dividend aristocrat. Yeah, so they've been, we use that same example. Let's 2012, 50 cents, keep it 10 years. It's paying nearly $1.50. I believe this year they probably will. Yeah, if they'll probably go over $1.50 this year in dividends. So, yeah, another great company to own, and with the fact that they keep increasing the dividends, it's another good company to have in your account for to earn those dividends. And then ratios, I believe the coverage is like almost 300. Let's see what the coverage is. Let's look at return on equity. So return on equity is good. It's at 30. The average is 28. S&P average is 19.5. So their return on equity is good. If you look at for similar companies, their price to earnings is relatively low compared to a lot of their competitors. And then if we look at their dividend coverage, 189, so it's a little lower than I thought. But again, for it's almost $2 for every single dollar that they're paying out in dividends. And let's look at earnings. So their earnings look good, and they're expecting 22 to be a bit higher than last year, almost by 7%. So their earnings look good. And then their revenue is going to be up by 6% this year, almost 52 billion. Cash flow is slightly down, but not too bad. So, their numbers look good. I don't really know exactly why they're down, but at $50, they're near that 52-week low, the 52-week low. And in options, they're very optionable. Yeah, so you can see here, like at 47.50, you got a huge amount of open interest, and it's paying between right around $1.95 to 99 cents. So, and it looks like the last trade was $1.19. So at 47.50, that's not a bad price to own it, but I would, you could probably even do like 45 or something along those lines. And then you can see the calls are really good. The fact that you can really get some good money on covered calls, so you could be selling covered calls at 51.50 or 52 and still be making some good money. So Cisco is one of my favorites. I sell a lot of puts on it. I currently don't own any Cisco, but I may let some of these get assigned because the cover calls can be so good, and it's something I want to own. It's just, typically it always seems to expire out of the money, or I can close it with, taking a good profit. So it's again another great company, and you saw right before I switched out of there, it's A rated by Schwab, so a good company, and it's probably one of the highest rated companies out there. And I use them quite a bit. I use some of their networking stuff that they have, and I also use their conferencing software that they produce. So, good company, going to continue to do well, and it's really good company for selling options. So, there you have it. There's what is that, seven stocks that you can use. You can sell these. You can do pretty well, and you're not taking as much risk. And in my mind, I'm happy with owning all of these or any of these, which you should be too. Especially if you can pick them up close to, slightly below these amounts, you're getting them at a really good value. Now, if the market keeps going down, you also have a little more cushion to keep rolling it down without taking the risk where you can't roll because you don't have enough premium, or it gets so deep in the money you can't get out of it and you have to let it get assigned. So that's it. I hope you enjoyed this. I hope you're doing okay. I know it's a little bit trying in the market right now, and I know that, like me, you probably have some positions that are, potentially deep in the money, and I hope I'm either going to let some of those get assigned or be able to roll them, and at least that's my hope. May be kind of an interesting month. It'll be interesting to see how it all ends up, and hopefully we'll not the market won't go down a whole lot more. Right now, it feels like it's going to keep going down. But when I felt like that before, sometimes it surprises me and it jumps back up. It is up a little bit today. So, again, thanks for joining me, and I hope you have a wonderful day.